Hi, and thank you for watching us here at Tax Talk UK, where we talk about all things tax and other important aspects of working for yourself, running your small business, being self-employed. So today we're going to talk about stock takes, and from an accounting perspective, why stock adjustments are important and what they are intended to achieve. Before I talk about that, if I could ask you please to take a moment to subscribe to our YouTube channel. That way you'll easily be able to refer back to this information if you should need to, as well as being able to more easily access other information that we have on a whole wide range of topics, all aimed at supporting you in your self-employment. So back then to stock takes and stock adjustments within your accounts. So, of course, there's lots of reasons why it's important for you to know how much stock that you have, insurance purposes, to make sure you're sufficiently insured, to make sure that you can fulfill your orders when they come through, and you know which stock you're low in, or that you need to clear, all those sorts of reasons. But today we're specifically thinking about why we need to account for those stock takes in our accounts and look at what those adjustments are doing. So a simple way to think about this is to go back to what an accounting period is aiming to achieve. So if, for example, your accounting period ends on the 31st of March, then what we're aiming to see in the accounts for the accounting period from the 1st of April until the 31st of March is how much profit has that business or company generated throughout that accounting period. And one of the things that's important is for us to know, well, this is the total amount of sales that were made. What of the costs were specifically made, incurred in making those sales? And we would be looking to make adjustments for things that perhaps either went across more than one accounting period, such as an insurance renewal that fell mid-year, or for anything that meant that purchases were made within the period but not sold within that period. We want the sales data and the purchase data to match per the period. So this is where your stock take information comes in. So if, for example, you in an accounting period, you purchased £1,000 worth of stock, and you sold in the same period £500 worth of stock. In that simple example, you can see that you've taken £500, but you've spent £1,000, so you've actually made a loss of £500. But let's imagine that out of that £1,000 stock that you purchased 10 of something that were £100 each, and you've only actually sold 2 of those, making your £500 sales, but actually you still have eight of them, so £800 worth of that cost. You still actually have that. You haven't actually sold that. So therefore you can see that really, although if left as it were, it looks like you've made a £500 loss in the period, actually you've still got £800 worth of that stock to sell in the next period. So therefore you've only actually, that £500 sale only actually had a cost of £200. So you have actually made a profit of £300. So in this scenario, what we would be looking to do would be to take £800 off of that purchase cost, out of that cost of sales, and we would move it onto the balance sheet into the stock code, and we would carry into the next period £800 of stock. Now, say, for example, in the second period, we purchased nothing new, but we made another sale of £500 and we'd sold another two units. Then for that year, you would see that if we hadn't have made any adjustments, it would look like you've made £500 profit because you've got no cost to offset it because they were all in the previous period. But actually you did have £200 worth of costs, and that can now, because we made that stock adjustment in the first year, we carried forward the £800. So now at the end of the second period, we can say, well, actually that stock is no longer 800, it's now 600. And then we move 200 back from the balance sheet item back into the profit and loss for the cost of sales for the purchases for the second period. So there we've accurately got two years now with the sales and the costs that were actually incurred for those specific sales. So again, the importance of this would depend on the amounts that we're talking about. If your stock is fairly fast moving and low value, and at the end of the accounting period you just have a very sort of nominal amount, you may decide that you don't need to worry about adjusting for the stock. But as you can see in the example where we looked at, you need to consider whether your profit and loss is an accurate reflection of the accounting period that it's for, or whether any stock held at the end of the period may have skewed this, and whether therefore you need to be making any adjustments for it. Because of course it's not, although it may be easier to just completely ignore the stock issue, it will result in fluctuations in your profit and loss that could have impact on you for other things. If you're a sole trader, for example, and you're looking to apply for a mortgage, then the lender will be looking for consistent and stable income from your business, or the profit from the business. So it's no good saying, well, my value of my profit went up and down, but it's because I didn't adjust my stock. You need to actually be doing the stock adjustment. And of course, if you think about it, at the point that you end your self-employment and you no longer do it, you will be looking to have a zero balance sheet. So everything on the balance sheet would be accounted for. So any stock that you had at the end of trading would be sold or scrapped and sort of therefore accounted for. So I find that it's always useful to look ahead to that time to help your understanding of what you're actually doing with your stock adjustments. So on your balance sheet, you yes, in your profit and loss, you are adjusting the profit by increasing or reducing your cost of sales, but you're doing that, the opposite entry of that is moving to the balance sheet. So as you can see by considering what happens at the end, is through the whole course of your self-employment, all of those costs will be accounted for, and all we're doing by making the adjustments is just to make sure that that they're accounted for in the correct year. So it's not a case of well, I'm reducing my purchases, or I'm increasing my purchases, so I'm affecting my profit, and which is obviously what your tax liability is based on. At some point that will all be accounted for, because in the final year of your trading, you will need to do something with that stock. And if you haven't kept your stock records accurately and your adjustments have been too high or too low, then that could impact you in the final year of trading. And of course, when you come to that time, it could be that you're going to do something else work-wise, or you're looking to retire. In either case, you don't want to be incurring a big tax bill because you haven't accounted for the costs in the right year. So then in the final year, you end up with all profit because you've got no cost to offset against them. So hopefully this helps to explain why we are adjusting for the stock and what we're actually doing and what we're trying to achieve. And that will help you to, if you can get your head around that aspect, that will help you to actually be assessing in your own business what stock adjustments you need to be doing, what stock you need to be assessing. So thank you very much for watching. Goodbye.